Hello, everybody. Let me pull this down for now. Mike Wisniewski here. I'm running solo today. Greg Kuda is on vacation, probably a much deserved vacation. But we he's still working. He has actually, from vacation, sent me the deck that he is using. Oh, I'm getting some feedback. Let me make sure I got. There we go. Take care of that. I know what's going on. There we go. Okay. He, he sent me the deck. So we're going to go through his deck here and kind of see what's going on in lumber futures in the last week. So, as well, please ask questions at any time. But without further ado, I'm going to jump into this and we'll make this full screen today so everyone can see it. All right, March 29th, we're coming to the end of the month, end of the quarter, and wow, what a quarter it has been. So, of course, this was put together by Greg Kuda with Westline Capital and StoneX. All right, the big overview. What do we see going on? I am going to zoom this in a little. So, crude is taking a crap or crush, getting crushed a little bit here. Amazingly to me, the stock market has been very resilient. So the black line here is the S&P, the green is Dow Jones, the blue is Nasdaq. It's laughing off a war. It's laughing off inflation. It's laughing off higher interest rates. I find that really interesting. So here's the orange line mixed up in here is lumber. So, one of the things you can see is that lumber and oil are sort of in lockstep a little bit, both moving down. And then this is going to be the big topic of the day right here. This is the 10-year note, and it's going down. I want to point out that the price of the 10-year note goes down when the interest rates go up. And I think many people are confused as to why that is. And I can give you a really quick explanation. Every 10-year note that the government puts out has a par value, or I think it's around 5%. So no matter what interest rates are, if the government issues a 10-year note, it's going to pay a 5% coupon. So the question is, would you be willing to pay more than $100,000 for $100,000 to get paid 5% interest on $100,000 amount, or would you be willing to pay less? So the let me rephrase that. When interest rates are lower than 5%, you'd be willing to pay more than $100 for interest on a $100 note. As the interest rates move towards the par rate of 5%, you're not willing to pay as big of a premium. Hence, the price falls. So, when the price of bonds is falling, that is an indication that interest rates are rising. I probably did a poor job of explaining. Oh, I have something blocking my camera. Oh, what is that? There we go. We'll fix that. Sorry. Um, so what? Look, what we know: interest rates are rising. That is absolutely true. Let me move this down to the next slide. All right. So this move has been extremely strong. We've gone up over a half of 1% or 50 basis points here in just the month of March. That's a big move. And in addition, now the rhetoric going on around what the Fed's going to do is the next two rate hikes are going to be 50 basis points. So they anticipate that we go up by 1% in the next over the next two meetings of the Fed. So what does this mean for the world of lumber? Well, the consuming region of lumber, which generally is houses, they're becoming more expensive to finance. 30-year fixed mortgage rates here have jumped considerably since they bottomed out just over a year ago in January of 2021. For the most part, we were pretty calm in 21, and then 22 started, and wow. So, what we can see here is a big jump. We've gone from under 3% to almost 4.5% on a 30-year fixed mortgage. That's a headwind. Absolutely. That is a headwind. Now, we can look at crude oil. And, one of the reasons we look at crude is just to see, what the overall economy, how it's affecting commodity prices. And crude is just an absolute bellwether. And what you see is that, so crude, while it's been extremely volatile, it's definitely rolled over here. And the target on crude, I would say right now is right around $90. All right. Let's get to Lumberland. This is the weekly continuation chart. So for perspective, the low here was in August of last year. At the September expiration, we were at about 455. And then from there, obviously, we peaked out just in front of the March expiration, just under 1,500. So, that's a pretty substantial move, almost 400% jump in lumber prices over the course of, about 8-9 months? But the big thing that I'm looking at now is this low, this $950 low approximate, which was, at the beginning of the year. And, will this low hold? It appears as though we're shooting down towards that right now. You could probably draw a trend line here. Maybe we've broken this trend. If you want to draw a trend channel, I think we're definitely testing the low end of the trend, or the trend line, the low side of the channel. All right, let's just look at the May daily. Now, this is where things get really interesting. If I am a pure technical analyst, I look at this chart. This chart is very bearish. While you can see, Greg has some of these long-term moving averages in here. We're breaking through, and we're almost to, I'd have to see what the gold moving average is, but, that, in my opinion, that looks like the target. That is $846. But I would say right now in the May chart, although today we're seeing a little bit of an up move overall, I think that the downside target is down here at the 846 level. One of the things we love to look at is the basis. Of course, basis is the difference between where the current cash market is and where this futures price. Now, while they are related, they are distant cousins at this point. They are very distant cousins. This May futures represents a rail car that's going to ship from a mill sometime between May 15th and May 30th. So you're looking at an arrival into the Midwest, for instance, in the middle of June. And right now, we're coming up on April 1st. So that's 2.5 months away. So the basis says the cash price is $343 above. I'm sorry, this was a week ago. $343. Cash was trading $343 above May. and today it's 360. Now, I don't need to tell you that this is way different than what we have historically known. The other numbers here are where we were in years past. So get out of there. So you can see, we were actually in 2020. At this point in time, we had a negative basis. And what is this, 2018? We also had a negative basis. So all things point to, if you need to buy wood for June, you are giving up, and you buy today's wood, you're giving up a massive amount of, you're paying a much bigger price. You're giving up profit, is what my guess is. And then as we look to even the further out months, the July basis. So this is wood that you would be using or wanting to land in your yard in mid to late August. You're almost you were at $485 a week ago. You're at $480 now. And then September. So this is wood for next fall. $540, $535. What does this tell you? This straight up tells you you should not inventory wood. This tells you that if you need to buy wood, your best bet is to find someone who will forward price you, or actually buy a futures contract for a hedge. Get past this. Let's go to the spreads. One of the things that we saw is in recent expirations, this is kind of the way it's been. The front month is very strong compared to the next month, and it was holding the same story here, but we started to roll over a little bit, and once again, from a technical analysis, you'd be very cautious, a cautious buyer here, because you're at the bottom side of this range. And then we're going to go fast forward to today. Yeah, we absolutely blew through that bottom side. We're down here. The spread today, trading down a little bit. Its last trade was 122. So we've dropped $40 or so since the previous. Yeah, we were here at basically around 160. Now we're down at 142. So the spreads moved down $40. What does this tell you? Basically, it's telling you that people are less excited about buying wood and holding it. They're saying that the further out you go with duration, the longer the time horizon, the cheaper the market thinks the prices are going to be. All right, let's take a look at open interest. Here's the open interest as of 3/21. We were at 2,500, and then the open interest today is 2,650. What was it? 25. I'm sorry, 2,500. So call it 2,600. We're at 2,650. We've picked up a little bit. The interesting thing I see there is, as the market is moving lower, a lot of times if people are leaving the marketplace, leaving just exiting positions, they're confused. It seems as though there's some conviction right now in these market moves, because people are not leaving the market. We can take a look at the open interest went from 1,645 as of the 21st in the May contract. I'm looking right here. We're down to 1,600, just about 1,600. So people are moving their positions a little bit from that May contract into the extended contracts, July, Sep. And I think this is probably one of the most important numbers to look at. This is our commitment of traders report. So this is back on the 15th of March. One of the things we see here is the producer longs. So this is industry participants. They had added 124 contracts to their positions, while managed money, they exited 173 contracts. The thing that I see that's interesting is 173 contracts is, about a third of their position is what they took off. So investor type managed money traders had a long position on, and the market has changed. The indicators were that they should exit that position, and they have. They've gone, it's pretty much running from the doors. Now, as the prices came down, I think there was a lot of business that needed to be covered, and you can see the industry stepped in and started covering some business. In addition, this is the really interesting number. Industry shorts added to their position. So my guess is that this was not people hedging inventories on the ground. My guess is this was producers like mills entering the market saying, "Look, these are fantastic prices from a historical standpoint. When you have 4 digits in the price, you know that mill is making a lot of money. It's time to lock in some of that margin." So I think the mills were adding to their short positions. Now, once again, this was on the 15th of March. Let's take a look at what things looked like. So this was a week ago, last Tuesday. Excuse me. The managed money continued to liquidate their position, granted at a bit of a slower pace. Excuse me. These numbers are really interesting. The industry, continues to buy in, probably covering some short business. But look at this number. Mills added to their short position. So if the mill's telling you, you're out buying wood and they're telling you, "Oh, we're going to see a bounce. We're going to see a bounce." Well, right here, the mills are telling me, I don't really see a bounce coming. I think these prices are still great, and I'm going to hedge. And by the way, this is an extremely important chart. And what it's telling you, it's important given the setup of our current market. One of the drivers of this price escalation, we see it here at Materials Exchange, I'll get into that in a minute, was the inavailability or the slowness with which wood was leaving the producers and getting to the end user. Basically, rail cars were moving so slow. Now, we've talked about it a long time. The producers have a flat production curve. That mill runs every day and it runs about the same. While the takeaway in the market tends to be more choppy, that mill needs to load cars every day and get that wood moving away from the mill. They handle that flat production curve in a choppy market through order file, meaning, in 1 week, they might sell 3 to 4 weeks of production. And then for 3 to 4 weeks, they don't sell all of they sell less than a week of production, and the order file will come in. But as far as shipments go, the shipments away from that mill stay consistent. Well, when rail cars were moving slowly, they had to look for other options to get that wood away from the mill. And they went into trucking. Trucking is more expensive. So you can see the input costs on all of the situation for the mill when rail cars slowed down was increasing. Meanwhile, the demand in the market was still strong. So the market wanted the wood, and there was a bit of a scramble for product. We saw that escalation in prices. So now I wonder, this is weeks of the year. Let's just take a look back. The rail cars really started to pick up pace the 8th week of the year. Guess what? That is March, around March 1st. And if we go back to the May contract, guess where March 1st is? March 1st is about right here. So just as rail car traffic started to increase in velocity, the market started to break. I don't think that's a coincidence. So it's super important as you're analyzing the market to you can't just hang your hat on one statistic. you got to throw in more interesting statistics, much like this rail car speed. Now, I would say, if this trend continues and we end up, these are basic highs. That means that our rail situation has remedied itself and is moving quite nicely. I've also heard from the railroads they're adding more rail cars, more capacity into the market. So I think that what you're going to see over the next 3 months is a normalization of the flow of wood, which that just means more supply into the market. Um, Lastly, let's we're gonna shameless plug to the StoneX Lumber Risk Academy coming up. Can't recommend that enough. We have always talked about that. But the one thing I want to just kind of highlight to wrap up today is let's go back to interest rates. This is that 10-year chart, or there's mortgage. Okay, what the reason the Fed is raising interest rates is because inflation is running very hot. Everything is getting more expensive. So they want to try to restrict and cool down the economy. So they make money more expensive. So I just said expensive in two ways. Everything's more expensive and they want money to be more expensive. This all adds up to trying to get the consumer to spend less money. Now, one of the the hidden drivers of the lumber market is the repair and remodel market, is the repair and remodel industry. When we first started COVID and we came, flying off the lows, um, one of the reasons cited was repair and remodel. People are sitting around with nothing to do, and they're going to add a new deck. They're going to add an addition to their house. We also, as the housing market, the underlying supply of houses was historically low. People said, "Well, I'm not going to move. I will just upgrade my house. I'll put on an addition, do some sort of upgrade." Well, I am going to go out on a limb and say I think the repair and remodel is in for a major correction. If you don't have that excess money, if you're filling up your SUV, which you just paid more than you expected for, and it's costing you $150 to fill up your SUV, the amount of free cash that the consumer has today is definitely shrinking, and it's shrinking by design. The Fed wants it to be shrinking because they want to curb inflation. So what I'm going to start looking for is the results coming out from Home Depot and Lowe's and Menards. Well, Menards doesn't report results. Home Depot and Lowe's. I'm going to start looking at what's going on with appliances, because when people do renovations, they tend to put in new appliances. So I think we need to keep a really close eye on that segment of the market. If I'm wrong, if repair and remodel stays strong, I think this market can stay strong. But if that repair and remodel market starts to really shrink, and I think it could be I think it could get tanked, by the way. You're looking at looking at headwinds, and there's the real possibility that lumber can correct, down to these levels. So let's just say we break this. Let's say we've broken the trend, and we want to start looking for downside targets. Now this is a weekly continuation. So this is November right here, and we're in March. So November, December, January, February, March, 5 months. If we extrapolate forward 5 months, that puts us right in this area. Is there any reason not to expect that we couldn't be down in this region, down at the 500 level? I'm going to say that my target right now is this. Probably, I think it's five. What is this? 550. From a downside target, I would say that's where we're going. Now, that all being said, if things turn around and we go racing back. The targets, of course, these old highs, and then the highs up here at 1700. But given all the headwinds, I personally think the likelihood of us heading back into this direction is more likely. Higher, there's probably a better chance of that. Okay, so what do you do? What do we do with all this? Do we go out and get short a whole bunch of contracts? Um, I don't know. That one of the things about getting short here is it's difficult to roll that short position at a profit. So right now, if you were short March or short the May contract, and you wanted to buy that short back and then sell the July contract, you're losing $120 on that roll. So it's a challenging market to get to long term be short. But if you need to be buying product, I think you need to look for opportunities to buy as extended a shipment as possible, and by no means pay today's price. Today's cash price in this environment, it's my opinion, is very unsustainable. There has to be some sort. We go back to that the basis. Everything tells us that this will converge. So somehow we need to get $343. Oh, that's last week. $360 lower in cash or higher in futures, or a combination of the both. All right, so I'm going to wrap it up there. I've spoken enough. If anybody wants these the slides from today's show, please feel free to send me an email, MikeW@materialsexchange.com. I'll send you these slides. If anyone has any questions, please feel free to reach out to me as well. But otherwise, thank you for watching. I hope it was informative, and we will see you next week. Greg should be back by then, unless he decides to stay in Mexico, which, not always a bad idea. But anyway, everyone, have a great week, and we'll talk to you soon.